Did you just sell a rental property and realize that the IRS now wants 20 to 30% of that profit? Or better yet, you're sitting on a highly appreciated asset and are avoiding selling because you know that the capital gains tax on it is just going to crush you? If you just nodded, you are in what I like to call the real estate tax matrix. Not a fun place to be. I'm going to show you exactly how the wealthy sell millions of dollars in real estate and don't pay a dime in taxes. We are going to break down the real estate tax loophole. Welcome to Tax Shmaxes. If you're new to this channel, I'm Edward Nisanoff, President and CEO of Nisanoff Tax Group, and I've been advising on advanced tax strategies for over 20 years. You may have seen us on Forbes, Yahoo, and Newsweek. And on this channel, I give you the blueprint for total wealth preservation. From maximizing your retirement portfolio and slashing your tax bill to advanced estate and passive income strategies. Make sure you subscribe and hit that bell notification so you never miss a strategy to level up your net worth. Before we get to the solution, let's talk about why selling real estate is so dangerous if you don't have a tax strategist. Let's say you bought a property 5 years ago for about $400,000 and the market is hot today and you decide to sell. The value? $800,000. You might think you've just gotten a great windfall. $400,000 in your pocket, pay a little bit of capital gains tax and walk away with the rest. But the IRS has a 1-2 punch that it's about to hit you with pretty hard. See, when you sell a rental property, not only are you going to pay capital gains tax on the appreciation, so the $400,000 from 4 to 8, but because you've been depreciating this asset for the last 5 years, again, it's a rental property, you had the opportunity to deduct a portion of that property over the course of 5 years through depreciation. And now when you sell it, the IRS wants that back through depreciation recapture. And you're not going to pay preferential capital gains tax rates like you would on the asset sale itself, 15, 20%, etc. No, the IRS actually subjects you to 25% depreciation recapture tax. So going back to thinking that you can sell it for 400 grand, pay a little bit of capital gains tax and walk away scot-free may have just turned to paying not just about 20% on the sale for the $400,000, but also whatever that depreciation you're recapturing, you're also gonna pay that 25%. So it can be a large amount if you don't plan accordingly. So what do the wealthy do so differently? They never cash out. Instead, they trade up. And they do this through a mechanism called the 1031 exchange. Section 1031 allows you to change a property, or rather exchange a property for a like-kind property and defer the capital gains tax and depreciation recapture. How far does this go on for? Until you sell the last property. And this is how the wealthy keep their wealth, not just in the family, but for future generations, because they'll keep exchanging these assets one after the other and trade up until they pass away. And when they pass, the beneficiaries of their estate receive a step up in basis, deferring all capital gains and depreciation recapture indefinitely. So going back to our example, you buy that $400,000 property, it's worth $800,000 today. Instead of selling it, you trade it up for another property that's worth $800,000. That capital gain is put into that property, or rather rolled into that new property, and the depreciation recapture as well. Now you hold that for another 5 to 10 years, and you keep moving that cycle and keep going through and basically rinse and repeat. When you pass away, that property will go to your beneficiaries and they will receive what's called a step up in basis. So let's fast forward. Your basis in this asset is at this point, let's say $3 million, because you've been doing this for the last 30 years. The fair market value of the next property, or the last property rather, is $5 million. And all that depreciation recapture and capital gains that you've just been rolling into this property all of a sudden disappears, because when the asset passes to your beneficiaries, they receive it at a $5 million valuation. And like magic, boom, they don't have to worry about capital gains tax or depreciation recapture. Now you may say, what about estate taxes, etc.? Yes, that may be there if the estate is above the $15 million threshold, but if it's below that, you have nothing to worry about. aside from maybe the estate tax issues. So instead of writing a fat check to the IRS for $150,000 on that $400,000 gain, you just take that extra $150,000 and buy another property with it, use it for that down payment, etc. And just keep kicking that can down the road. And the best part, the IRS's definition of like-kind exchange is pretty broad. So you can exchange a single-family home to a multifamily home, a residential to a commercial, and there's really no restriction there. The only restriction is that it has to be real estate. Like-kind exchanges of other assets are no longer available under the new tax law. Now, before you list your property, you have to understand that the IRS does not make this easy. There are very strict rules that you have to adhere to. And if you miss the deadlines by even 24 hours, the entire exchange could be blown and you may end up having to pay the capital gain tax on the asset that you just sold, even if you already bought the new one. So this is exactly why you need a tax strategist to be able to walk you through the process. So what are the rules? There are 3 that you must adhere to. The first one is that the proceeds from the sale cannot hit your personal bank account. Not only can they not hit your personal bank account, they cannot hit a bank account of a related third party, meaning they can't hit the bank account of your personal attorney or their attorney that's dealing with this exchange. They can't hit the bank account of your, let's say, accountant. I don't know why they would do that, but just as an example. They can't hit the bank account of any relative. It has to hit a bank account of an independent third party that is referred to as a qualified intermediary. And they hold those funds in escrow until you acquire that next exchanged property and they pay the seller on that exchange. Very important, you can't have access to those funds. Number 2, there's a specific window where you have to name the property that you're going to buy. Meaning, once you decide you're selling the property and you go into contract, you have 45 days to list the replacement property. So you're gonna say, I'm selling 123 Main Street and I am going to purchase 456 Smith Street. Now, it's very specific. You have to ultimately buy that property. You can also list about 3 properties on that exchange and you must follow through with that. Number 3, you have 180 days to close on that next property. So you sell 123 Main Street today, you have 180 days to close on 456 Smith Street. And if you don't meet those 3 criteria and you do something outside of those steps, then the exchange is disqualified and you're stuck with a massive tax bill. A situation that nobody wants to be in. Trust me, I've had clients come to me after the fact, not using a qualified intermediary because they heard a video on the internet or heard through a friend that as long as you purchase another rental property, you don't have to worry about capital gains tax. And we had to be the bearer of bad news and tell them, sorry, Mr. Client, what you had done was completely incorrect, and unfortunately, you still are subject to the capital gains tax. Not a conversation we want to have, especially after the fact. That's why it's important to speak to your tax strategist before the fact to make sure everything is aligned and you execute properly. We just helped a client with a 1031 exchange. Earlier today, we spoke on the phone with them, had a bunch of questions about the 1031 exchange, and they also wanted to know, hey, can we move into this? Because it's actually on a beautiful waterfront, and that's something that they're looking to consider when they retire. The answer may surprise you. Maybe I'll speak about that on another video. So I know what you're thinking. You're thinking, Edward, but if I keep doing this, don't I have to pay taxes eventually? The answer may actually surprise you. This is called swap till you drop. And what you essentially do is keep rolling these properties into each other until you pass away. So at the end of the day, a tax preparer is gonna let you know how much tax you owe on that disqualified exchange. The tax strategist is gonna make sure that you're aligned correctly and execute the 1031 beautifully. If you're a real estate professional, a high income earner, or business owner, you can't play a guessing game with your taxes. You need some strategy. Click on the link on the description below and schedule a complimentary strategy session with Nissan Tax Group. We're gonna look at your tax picture, see where those holes are, and come up with a blueprint for wealth preservation and success in 2026. If this video opened your eyes, hit that like button, subscribe to my channel, and in the comments, let me know what type of real estate are you looking to invest in next? Now check out these wealth preservation strategies next. Go ahead, click on them. They're not going to be here forever.